After studying this module, you shall be able to understand the concept of foreign exchange derivatives, assess the risk in derivative trading, know the meaning of forward foreign exchange and its payoff profiles, differentiate between forward rates versus the expected future spot rates. Risk and business are perhaps inseparable. Every businessman has to take risk and manage them well to create profits. Management of risk gives rise to a concept of derivative. It is basically an instrument used for minimizing the unwanted risk that do take place in the future. Traditionally, corporations are known to manage their risk in a variety of ways such as insurance, letters of credit, joint ventures, etc. Nowadays, companies are using derivatives to construct a hedge against the risk. Therefore, derivative instruments are considered as the valuable tools for implementing risk management strategies. In this section, we will be discussing about the concept of derivatives, risk on trading in derivatives. Moreover, the chapter also discussed the computation of forward foreign exchange rate and its payoff, and also the difference between forward exchange rate and expected future spot rate. Concept of foreign exchange derivatives. The term derivative indicates that it has no independent value. That is, its value is entirely derived from the value of the underlying asset. The underlying asset can be securities, commodities, bullion, currency, livestock, or anything else. A derivative instrument by itself does not constitute ownership. It is instead a promise to convey ownership. The features of derivatives are traded on exchange. All transactions in derivatives take place in future specified date. Derivatives are often leveraged such that a small movement in the underlying value can cause a large difference in the value of the derivative, and hedging device reduce risk. Types of derivatives. Figure 1. Types of derivatives. Participant in derivative market. Hedgers use futures or options markets to reduce or eliminate the risk associated with price of an asset. Speculators use futures and options contracts to get extra leverage in betting on future movements in the price of an asset. Arbitrageurs are in business to take the advantage of a discrepancy between prices in two different markets. Economic functions of derivative markets. Some of the salient economic functions of the derivative market includes: first, prices in a structured derivative market not only replicate the discernment of the market participants about the future, but also lead the prices of underlying to the professed future level. On the expiration of the derivative contract, the prices of derivative congregate with the prices of the underlying. Therefore, derivatives are essential tools to determine both current and future prices. Second, the derivatives market reallocates risk from people who prefers risk aversion to the people who have an appetite for risk. Third, the intrinsic nature of derivatives market associates them to the underlying spot market. Due to the derivatives, there is a considerable increase in trade volumes of the underlying spot market. The dominant factor behind such an escalation is increased participation by additional players who would not have otherwise participated due to the absence of any procedure to transfer risk. Fourth, as supervision, reconnaissance of the activities of various participants become tremendously difficult in assorted markets. The establishment of an organized form of market becomes all the more imperative. Therefore, in the presence of an organized derivatives market, speculation can be controlled, resulting in a more meticulous environment. Fifth, third parties can use publicly available derivative price as educated prediction of uncertain future outcomes. For example, the likelihood that a corporation will default on its debt. Risk in derivative trading. It is true to say that derivatives are tools of managing risk for the hedger. It is equally true that trading in such instruments may be proved to be very risky. Risk involved in trading on derivative is due to the involvement of high degree of leverage. As we know, for taking positions in the cash market may require big amount of money. The same can be done in the derivatives market with a fraction of it. As we know, in case of an option, the holder of an option runs the risk of losing his entire money that he invested in buying an option in a relatively short period of time. Thus, if the holder does not find a suitable matching option in the secondary market or does not exercise it on or prior to expiration, he is sure to lose the entire amount of money he invested in the option. Therefore, it is important that an investor in options should be able to correctly predict the direction of price changes of the underlying asset. Moreover, it is also useful to assess the time at which price likely to be changed. It is to be noted that derivatives risk are totally different from the traditional financial instruments such as equities, bonds, etc. Different types of derivative trading risk. Basically, there are 5 types of derivative risk which may arise in the trading of it. First is the credit risk. It is also known as counterparty risk. It is the risk of a debt turning bad. It could be a country risk if it involves cross-country exposure. It may be due to the deterioration in the rating of the counterparty. Like in the case of loan, the assessment of risk is very simple. But in case of a derivative, credit risk is difficult to assess. For instance, a bank buying an option does not know the value of the underlying at the time of maturity. Similarly, it does not know at the time of purchase of an option whether the other party will be obliged to it, and if yes, then how much. The second is the market risk. It includes all such risks that are driven through demand for and supply of at a marketplace. Hence, it includes currency risk, interest rate risk, price risk, etc. In other words, changes in the value of a contract owing to the movements in the market price lead to market risk. Third is operational risk. It is an act of setting risk limits and risk control systems for managing risk under derivatives trading by the top management for the traders in the treasury give rise to operational risk. For example, one of the major operational risks associated with the trader's inability to sell the financial risk asset quickly at its fundamental value. Fourth is the entrepreneurial risk. It is also known as the strategic risk, which may arise due to wrong decision taken by a bank or any financial institution regarding the selection of any project like infrastructure. Having invested so much in establishing a center for trading in derivatives, but being late in offering services may find it too difficult to penetrate into market. In this way, such risks are associated with the derivatives trading. However, such risks are under control to manage. The fifth is systematic risk. These risks can lead to complete failure of the financial system. Given the fact that derivatives are envisioned to redistribute risk in the financial system, the unknowns attached to derivatives trading and the growing volume of trading compel one to fear that any collapse of a derivatives user with a larger position can result in a systematic risk. The next is meaning of forward foreign exchange and its payoff profiles. In a forward contract, both parties enter into a contract on a given day and lock in a fixed rate on specific future date. In such types of contract, the terms of the purchase, that is buy or sell, are agreed up now, trade execution date, but actual exchange takes place on a date in the future maturity date. On the maturity date, both parties exchange the pre-negotiated rate, that is the rate at which contract started. Payoff on a forward foreign exchange. Let FT is the forward price of the foreign currency at time t. Then the payoff per unit of foreign currency at maturity time t, that is capital T, depends on the future spot rate, that is capital S bracket small t. If you purchase the foreign currency forward, the payoff equals ST minus FT. You win if ST is greater than FT and you lose if ST is less than FT. For example, an Indian company which is likely to earn foreign currency, that is euro, on account of an export order after 1 month may enter into a contract today, that is trade execution date, to sell euro and receive Indian rupees after 2 months, that is the maturity date. The rate is fixed on the trade date and the rate is to be known as forward 2-month rate. Suppose on trade date, the Indian exporter agrees to sell euro 1000 and receive INR 72,450. On the maturity date, he delivers euro 1000 and receives INR 72,450. Such types of forward contracts are known as outright forward contracts, that is OFTs. The OFT exchange rate are quoted as differentials, that is at a premium or discount from the spot rate. For example, if the base currency earns a lower interest rate than the term currency, then the base currency will trade at a forward premium or above the spot rate. As forward contracts are OTC contracts, there are many variants to it. Forward contracts can be many types depending on the rigidness associated with the maturity date. In a fixed maturity contract, the maturity date is fixed. The payment and receipt happens on the maturity date. Partially optional contracts provide some flexibility. In such type of contract, there are three dates: trade execution date, option start date, and maturity date. On the trade execution date, two parties agree to exchange and the rate of exchange is fixed. In addition, the parties can settle the transactions anytime during the option start date and on before maturity date. In other words, in this contract, the maturity date spans across days rather than a single day. In fully optional contract, the contract may end any time during the life of the contract, that is, any time during trade execution date and maturity date. The next which we are going to understand is the forward rates versus expected future spot rates. Under this section, we will analyze the basic difference between forward rates and expected future spot rates. It is normally understood that the forward rate is merely what the market expects the spot rate to be at the future date. On empirical grounds, it is not true. The forward rate differs from the spot rate only because of the interest rate differential. Multinational corporations, multinational banks, and other international financial institutions enter into forward contracts to take the advantage of the forward exchange rate is determined. Such determination of forward exchange rate, which reflects equilibrium in an economic, eliminates all arbitrary opportunities forward rate for hedging purposes. With the help of linear association among differential interest rates and the spot foreign exchange rate taking place between two countries, the unbiasedness hypothesis states that given the conditions of rational expectations and risk neutrality, the forward exchange rate is an unbiased predictor of the future spot exchange rate. Without introducing a foreign exchange risk premium, which is due to the assumption of risk neutrality, the following equation illustrates the unbiasedness hypothesis. Ft is equals to Et into St plus K, where Ft is the foreign exchange rate at time t. Et into St plus K is the expected future spot exchange rate at time t plus k. Here k is the number of periods into the future from time t. The empirical rejection of the unbiasedness hypothesis is a well-recognized puzzle among finance researchers. Empirical evidence for co-integration between the forward rate and the future spot rate is mixed. Researchers have published papers demonstrating empirical failures of the hypothesis by conducting regression analysis of the realized changes in the spot exchange rates on forward premiums and finding negative slope coefficients. These researchers offer numerous rationales for such failures. One rationale centers around the relaxation of risk neutrality while still assuming rational expectations such that a foreign exchange risk premium may exist that can account for differences between the forward rate and the future spot rate. Let us now summarize what we have studied in this module. Risk is a characteristic feature of all commodity and capital markets. Derivatives came into being primarily for the reason of need to eliminate the price risk. Derivative is a financial instruments contract whose payoff structure is determined by the value of an underlying commodity. Derivatives are specialized contracts which are employed for a variety of purposes, including reduction of funding cost by